This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to Not Fintech Investment Advice. My name is Alex Johnson. I'm the creator of Fintech Takes, and I am joined live and in person by the great and powerful Simon Taylor, author of Fintech Brain Food. Simon, it is so awesome to sit across the table from you live at Fintech Meetup to record Not Fintech Investment Advice.
As a fintech nerd, I am loving this, my friend. How's your Fintech Meetup been?
It's been wonderful. I've really enjoyed it. It's Money 2020 sort of turned down from 11 to like 6. And so it's still very good, right? It's big, it's active, there's lots of stuff happening. But I also feel like there's places to sit, there's room to have conversations. I've bumped into all the people that I wanted to find time to chat with. So it's been ultra productive, really enjoyable. You might hear in my voice that I've been using my voice a little too much. So glad to be doing the podcast on the last day, but it's been great. How's your Fintech Meetup been?
Yeah, 2 observations. I've had 2 questions at every single dinner or happy hour every time I bump into somebody from a bank or a payments company. Number 1, will the regulator let us do AI? And so going to have to talk about that.
Yep.
And number 2, what should I do with stablecoins? And I'm like, well, that just tells you everything you need to know about where the industry is right now. So that sort of getting a pulse and a feel for it is why we come to these things. That, and it always feels like a little family reunion, being around the nice people, being around the nerds.
It absolutely does, yeah. And I will say they've done a great job of curating the right speakers, the right types of meetings. I missed Fintech Meetup last year, but I had gone the year before, and very similar vibe of just, kind of like a fintech family reunion. So it's been very fun. It is delightful, Mr. Taylor, to see you in person. I'm so glad we get to do what we do, which is on this podcast talking about early stage fintech companies maybe that aren't on folks' radar, but that we think maybe indicate where the market is going or trends that are interesting to us. So, Simon, you have picked some very Simon Taylor-y companies, as we were just joking before we started recording. So why don't you give us your first very Simon Taylor-y company for Not Fintech Investment Advice?
Yeah, so this is Payman. Payman AI is the agentic payments API.
Okay.
So they're actually an API and software development kit for agentic payments. What they do is they create wallets for the agents and a sandbox for that agent to operate within. Mm-hmm. So they're essentially going, this is your little sandbox. You live inside it.
Yep.
Everything in that sandbox is audited, monitored, and can be flagged for a human review. Mm-hmm. And they've secured investment from Visa, Coinbase, and Circle.
Wow.
To build the most secure way to pay via AI. So immediately, I think, what's the moat here? This is kind of an interesting company that is a model. I covered the 4 models of agentic payments, and this is model number 4, which is stablecoin wallet plus agent, kind of put together. Mm-hmm. And the interesting thing about stablecoin is because it uses wallets and signatures, you can essentially make sure that that agent can only spend a certain amount of money in a certain way. And the other interesting thing about that is, because it's on-chain, by default, it's kind of transparent. Like, the transactions are all there and seen.
Sure, yeah.
But what you don't know is what's happening outside of the money movement on the stablecoin. You don't know what the agent's up to.
Yep.
So by putting the agent inside a little observable sandbox, in theory, you can see everything it's doing as kind of well. So it's a smart model and an obvious target state. But my question is, can this team execute and sell? Is the market ready to buy this yet? Can they nail the go-to-market? And, having the investors they do with Coinbase and Circle can't hurt because of the stablecoin side.
Sure.
Visa can't hurt, but it doesn't mean they're going to win. So, as I said, everybody's asking me will the regulator let them do AI?
Yeah.
But the other thing is how the VCs all ask, how will agentic payments work? So what say you, Alex Johnson? How will agentic payments work?
Oh, gosh, put me on the spot. So I actually have had quite a few conversations with folks this week about agentic workflows and agentic payments specifically. And I guess the general premise, right, is that agents are only good if they can actually do the thing for you, right? Otherwise, they're not useful. And do the thing in a sort of capitalist society often means paying someone for something, right? Like to actually execute a transaction, to get something done, to do something on behalf of a user oftentimes requires the ability to actually transact, right? And so I theoretically really like the idea of agentic payments and building sort of a software development kit and a sort of sandbox environment for agents to be able to make payments. I think the thing that I am most kind of curious about, and someone I was speaking to actually this week put it this way, right? Which is when we went from brick and mortar to e-commerce, or we went from e-commerce to mobile-enabled commerce, what were the things that caught credit card issuers, networks, merchants by surprise when those transitions happened? And what can we learn from those transitions that we can then try to apply to this shift to agentic payments? Because much like e-commerce and mobile commerce, it does seem very likely to me that like we are going to have agents paying for stuff. The value is pretty obvious that like much in the same way that if you have a really great executive assistant who you trust with your credit card and they can like book purchases on your behalf, like that same model applies to AI. But, you know, to me, and you touched on the regulatory side of it, one of the biggest questions I have around this is how do you sort of ensure accountability, right, around these payments? And when I talk to regulators, that's the thing that they worry about.
Accountability.
Yeah, and and there are these like weird examples, very sort of proto examples that are very early. But I mean, you saw the one of the airline in Canada that made up the reimbursement policy for the customer. And then the airline said, no, we actually don't have that policy. You can't get this kind of ticket. And the customer sued and said, well, your chatbot told me that we could. And the thing that I think freaked out a lot of regulators about that case was that the company, the airline, made the argument that, oh, that was the bot doing that. That wasn't us doing that. And they tried to sort of advance this novel legal theory that like, we're not liable because that was the bot, not us. Now, the court in Canada shut that shit down immediately and didn't buy that.
Critical third parties and third-party risk management. And,
and just like this idea of like, when we say agent, right, like in a legal sense, in a compliance sense, agent is someone acting on behalf of a principal to do something. And there's a responsibility that you have as an agent. And so I don't know that the sort of liability and accountability frameworks have been built for this. But if these guys can build, and sounds like they have taken this approach, a sandbox and an observable environment for this thing to operate in, if it's transacting via stablecoins and that's being tracked on chain, it at least is creating the data and the observability necessary for that accountability, even if the rules aren't necessarily there. So I would say, I don't blame Visa, Coinbase, Circle for taking an early bet in this area. That's what they should be doing. I will say it does seem a little early to know exactly what some of the frameworks are going to be that govern this, even if it seems likely to happen in the future.
Yeah, it's difficult to know, isn't it? Without question. The governance is probably simpler if it is using a virtual card.
Yes.
Right. So if I'm using a virtual card, then I sort of know what that is. And it's fascinating to me that that's kind of where Stripe immediately went, which was the agent is firstly given a standard authentication by the Stripe customer with a strong customer authentication like Stripe Link with two-factor authentication. Then the agent is issued a virtual card, and that virtual card constrains what the agent can do. Kind of like giving an employee a virtual card.
It's exactly like that. Yeah.
So in theory, I, as the principal, am giving the agent some authority to operate within it, and it's constrained by that virtual card and the balance that's available to that virtual card. This is a similar model. It just happens to use stablecoins, but the new bit is putting the AI agent inside of a glass box and saying, we're going to observe everything you do. And so to that question I've got all week, which is, will the regulator ever allow it? Well, yes, if you define your accountability and how this fits within your group risk and control functions, because you still have all of the responsibilities around audit, around governance, about group risk and control, about explainability. And I think the worry is that these things, quote, hallucinate.
Sure.
And sure, they do.
Yeah.
But there are ways to manage that, just as there are ways to manage machine learning models, just as there are ways to manage humans.
I was going to say, yeah, like humans make bad decisions in a sort of hallucinatory fashion often. And we've figured out, if you use the corporate card example, right? Like that's why we have card controls. That's why we have multiple layers of approval. That's why we have these things, because humans make crazy decisions too.
Policies, procedures, controls, and training.
Yes.
Training and audit and observability. So we take our audit and we learn from that and we adjust our training. Well, that's exactly what you do with an AI agent. And I think when people get that this is exactly what we do with the humans, just slightly different for AI agents, they can kind of move forward on it. But Payman's going to be an interesting one. There's also Skyfire that does something very, very similar.
Sure.
I think this category is now starting to emerge. So let's see where it goes. Do you think we're going to see any companies doing things like this really gain traction in the near term, or is it all going to end up on cards? Because that might be what we saw with mobile. It might be what we saw with e-commerce.
Well, I mean, if Visa has their way, right? I mean, like, I think that one of the things that's very obvious to me walking around this week is incumbents are paying attention to this stuff, right? And they're not going to, and that's why I brought up e-commerce and mobile, right? They're trying to sort of learn from the recent past in terms of not being caught by surprise by these shifts in technology. And I do think that relative to some of those previous eras, I don't think agentic commerce is going to catch a Visa or a MasterCard or a Stripe by surprise. I really don't, right? And so I think that the question about who is ultimately going to control this, it's a little hard to say, right? Because a lot of what the card networks have built in terms of governance and processes and procedures and things that govern virtual cards and tying those into software that directs different workflows, all of that could theoretically be applied to agentic commerce, right? And it might be a really good fit in some ways for that. So whether we retrofit sort of an incumbent business and set of network rules, or whether we develop new businesses and new networks and new rules, I don't know. It'll probably be a bit of a mix. I guess one other thing I'm curious about, Simon, before we move on, is there would seem to be a line between autonomy and accountability, right, as it relates to this. And what I mean by that is the benefit to having someone do something on your behalf is that they will do it better than you could do.
Yes.
But that requires giving them a certain level of autonomy and trust to do that thing, right? And so this is like, hey, Alex Johnson, employee at this company, here is what we want you to do as a part of your job, and we will give you the ability to execute payments or sign contracts or do whatever within certain parameters. But within those parameters, like, we want you to do your thing, and like, we trust you. We hired you. That's why you're here. Like, do something better than we could do if we had to do it ourselves. With agentic commerce and with these AI agents, I'm a little stuck maybe on what are some like examples of workflows or types of payments where the benefit of having an AI agent do it on behalf of someone, how does that create value while also not being so just like wide open and allowing the agent to do stuff that you have that control? Does that like tension between those two things make sense to you as kind of a challenge?
Yes, it fundamentally does, because the more autonomy the agent has, potentially the better results it can deliver.
Yeah, it can go do more stuff for you.
Yeah, the more convenient it becomes, and the less it can do, the worse it is. And this is why actually you see a lot of the incumbent announcements around what they're doing with agentic AI. It's kind of like, oh, is that it? It's like, oh, another chatbot. Oh, you're summarizing a PDF. Like you do that with the base model ChatGPT, because their risk appetite is naturally lower. Whereas some of the innovators are like, yeah, I was doing the dishes for me. It's running my mortgage. It's taking care of everything.
Right.
And ultimately, that is always going to be a spectrum of what risk consumers and businesses are willing to take depending on where they are. But I think there's this split between AI native and AI sort of, I don't know what the term is, tourist or something.
Sure.
Somebody
curious maybe.
Yeah, coming into the space or adopting AI.
Yeah.
The AI native companies have built their whole company with AI tools from the ground up. They tend to be very, very small. They tend to be very high growth.
Yep.
And they their entire stack is AI and their default AI. So it's a very different mindset to I'm adding it to what I already do.
Yeah.
And so I was having a fascinating conversation with a few of the guys that are sort of on the cutting edge of this, and they were saying one of the things you have to wonder about is, are AI agents driving a website the right model for the future? Or actually, do we need an equivalent to sort of like an API where I as a merchant can publish my inventory to those agents and they can just read it and understand it so that it's correct, so that they're not trying to come to the website? Because if an agent's going to a website on your behalf, that's backwardly compatible.
Yep.
But how do I know that this is a good human and a good agent, or a bad human, good agent, or a good human, bad agent?
Yep.
What's that agent authentication look like, and how does that relate back to the... So you end up in this like tricky kind of space.
Yeah.
But if there's this agent authentication layer and then there's something like a model context protocol to really take your inventory and speak back out to the agents, maybe it's AI native. And I suspect neither of these things are wrong. History tends to lean towards layering over what's already there, and agents are probably going to be using websites, and most of us will never look at a website ever again, and we'll just use Whisperflow to speak our desires, and things will show up at our house.
Yep.
But who knows with these things, man?
It is hard to say. I mean, I do, to your point, I do wonder about the idea that we could be doing all of this much more efficiently if we just let agents fight it out between each other, right? So like the business has an agent, the consumer has an agent, and they're just interacting directly. And to your point, speaking in a more native protocol than like interacting through a website. Because why does one agent need to have a website if it's talking to another agent? The website was built for humans. Well, if a human isn't using it, why do we need a website? So I am intrigued by that. I think the challenge, and this ties back to your regulatory point, is when agents are talking to agents at a very fast speed and are doing so in a way that's maybe less visible, explainability then rises to the top of a concern where like, I don't even know what just happened there. They like did something, they came to a resolution, and maybe the result was good, but I don't know exactly how it happened or what was the sort of observable effect there. Maybe in commerce that doesn't matter. Lending and some other areas, it probably matters quite a bit more, which I know you've written about. Simon, I'm going to stay on the same general path of AI for my first company.
Go on then.
Okay. So mine is Shibboleth.
Shibboleth. Why have I heard of this?
You probably are familiar with them. So they are they came out of YC. They are an AI-powered compliance monitoring dashboard for banking as a service banks. And so essentially what they do is they use AI to help banks in a more efficient manner screen customer complaints, monitor customer service calls, review marketing materials, and even review transactions to look for compliance violations, right? And so if you think about the way that sort of traditionally compliance was handled by banking as a service banks, it really sort of depended on very sort of diligent work up front to evaluate the fintech company, and then a certain amount of trust that the fintech company was just going to do things the right way. And, you know, maybe you do a little sampling or you do a little bit of sort of automated testing here and there to try to poke for things. So it's sort of a trust but verify model. But I think where we've seen banking as a service evolve over the last, 12 to 18 months is that there's less of a tolerance for, if you think about trust but verify as sort of a continuum, we were sort of on the trust with a little bit of verification side of the continuum. I think regulators and the market are sort of moving towards trust and verify, but with a lot of constant verification happening. And so Shibboleth seems to me to be built to sort of enable in an automated, efficient, sort of AI-driven fashion, more of a constant verification that the fintech company is doing the right things, right? And it's tough because, if you think about like customer complaints as an example, there are reasons that customers will complain that have nothing to do with the fintech doing anything wrong, right? Like when you're dealing with people's money, stuff happens. Sometimes people just have questions. A lot of times it's just a one-off thing or an easy mistake to fix. Or a customer complaint can be the canary in the coal mine of some larger problem that you didn't see, or some change in the business, or hey, they added a whole new sort of, set of marketing materials to their website that are confusing customers that they didn't run by you before they were put on the website. That type of canary in the coal mine customer complaint, the question is, how do you sort that one out from all the ones that actually aren't concerning? Well, if you use AI, theoretically, you could do a better job sort of screening all of those and flagging the ones to the bank that this actually might be the indication of a larger problem or a pattern that you need to get ahead of. And doing that quickly is really important because, as we know, the problem for the bank is the faster they can identify any potential problems, the less remediation they have to do when a problem happens.
And if it's a needle in a haystack, that's hard to do.
Exactly. If the incidence rate is too low, you're just not going to catch it.
They're making a complaint because they're upset or their financial situation is bad, or they just pressed the wrong button and they didn't know how to contact somebody,
right.
Or they just had a bad day or whatever. And it's, that is something I've seen. Actually, so the UK government's equivalent to the Social Security Administration, the Department for Work and Pensions, uses something similar because if somebody doesn't get their Social Security check, that can be the end of the world for that person.
Yeah.
And there is a tiny fraction of those people for whom it's a suicide risk.
Yeah.
And if that's the case, you want red flags, warnings, you want all kinds of stuff.
Absolutely.
But of course, when you're dealing with millions and millions of people, that is a needle in a haystack. And there are weeks and weeks of unopened letters. And bits of paper and emails and phone calls. And it's very hard to spot those needles from the haystack. AI happens to be really good at that.
Yes, especially when in an unstructured sense. Like one of the things that Shibboleth talks about that I think is really interesting is like, we can just monitor calls, right? And like calls are a great example. I mean, this call is being recorded for quality assurance purposes, blah, blah, blah. We all hear that. But the reality is, call transcripts are kind of useless if they happen in large volumes because no one's actually going to go back and like look through them. It's this really hard, unstructured data that's difficult to extract meaning from. We know that large language models can do that very well, right? And so the ability for it to listen to, summarize, and pull insights out of all of the transcripts of these calls is another way that you can tell, this customer was just complaining about a thing that is actually a pretty easy fix and there's no sort of larger compliance problem here. This customer was flagging something that actually might be indicative of a thing that we don't know, that we at least want to have a human being look at. So it's not making any decisions, right? It's not like, this platform is going to shut down this fintech program automatically because it's had these violations. It all gets surfaced to human beings who review it. But as with a lot of stuff where we've seen generative AI kind of grab a foothold in financial services, it's about building an efficiency layer that human beings can sit on top of rather than having them just have to sit over all the raw data and try to sift signal from noise.
And that's the critical thing. So one of the things I've been thinking about a lot is, how do you take your existing policies, procedures, and controls and let the AI understand what it's looking for? And then when it's looking for it, surface that to a human with its case, with its argument, with its evidence. It's one of the things we've done at Sardine is we have this .kyc agent where it's looking at sort of name, date of birth mismatches, or when it's using different languages and all that sort of stuff. It will gather all of the information it needs that can take 45 minutes and compress that into seconds, but it presents that information to the human who makes the decision. And I think that from an accountability framework standpoint is just far more acceptable to especially regulated financial institutions than anything else. But also it's very meaningful because it has gathered all of that stuff. And then has it gathered the right stuff? Well, give it an audit, give it back testing, to give it training, give it all of those sorts of things that you would give the human if they were gathering it themselves.
I think that's exactly right. And it's funny, I was in, so you were helping with the Air Tech Sprint, right, on Bank's fintech arrangement. So I was in DC for the last tech sprint they did on that. And it was interesting because actually the founder of Shibboleth was there. So like very actively participating in it. But it was interesting because data and analytics and AI was like the primary focus that almost everybody had, right? And so there's this sort of, I think, recognition broadly now that problem that we've had with bank fintech arrangements really is a lack of visibility problem, right? Like these banks just can't keep track of everything that these fintech companies are doing. And quite frankly, a lot of the banks that are participating in this market, and like Bancorp apparently is a listed customer of Shibboleth, so they have some kind of early design partners that they're working with. The banks that are in this space, they're not huge banks, right? They're not, JP Morgan Chase does this stuff too, but a lot of banking as a service is still handled by relatively small community banks where there's just not enough manpower to throw at it, even if humans could do as good a job as the AI, which probably can't, but even if they could, you don't have the people to throw at it.
Well, and consider too that the volume of these things is increasing.
Yes.
So, what was it? The FTC saying that amount of fraud was up another 125% year over year.
Yeah.
In 2023, it was 2.5 billion. It's now 12.5 billion that consumers lost, and that's just the reported stuff. Same's happening on the SARS and the suspicious activity reports on the compliance side. And every time a customer is stuck in a queue, they're not using the product, they're not converting, they're not onboarding, that's lost revenue. So there's a real business case to kind of getting this right for the bank, but it's also, there's a real human cost of not getting it right. And the hardest thing to figure out is, okay, how do I make it comply? And there's a lot of learning to do in order to kind of get there. So I think we're on a journey as an industry, but I like that people are asking that question, and I like that people are really wrestling with it, because it is a difficult question to answer. I don't know if you've ever sat in a regulatory exam.
I have, actually.
Yes. Was it fun?
No.
And I have a lot of sympathy for the financial institutions that have to do that on a regular basis. Because at the state level, depending on the agency, the federal level, your results may vary, your experience may wildly vary, and you will get asked tough questions by people who, frankly, let's say the quiet part out loud, might not understand this stuff themselves.
Yeah, for sure.
And so they're asking questions based not necessarily in the most level of understanding. So if you don't understand it particularly well, they don't understand it particularly well, your best course of action might be to do nothing.
Yeah, no, I mean, it's 100% true. And I will say, just to wrap up on this one, that one of the challenges that I constantly hear from bank partners that are in this space is that they can be doing all the right stuff. But to your point, from a regulator's standpoint, if you can't show your work, you're sort of screwed, right? And so regulators really, for obvious and valid reasons, they really prefer documentation. They prefer to have everything buttoned up. Like, you can't, it's like doing your homework in school. Like, the teacher, gave me a bad grade even though I got the problem right. And it's because you didn't show your work for solving the problem.
Yeah.
Banking as a service is a lot like that. You have to show your work. And so I like the idea of more of these platforms existing that essentially allow you to show your work and demonstrate that, like, we are actively monitoring all of these things. If anything comes up, this is how we're going to catch it. And you're just demonstrating sort of a paranoia in a sense of, like, what could potentially go wrong. Because as you point out, there is a human cost to this stuff getting messed up.
And it's better than sample testing.
It is vastly better than sampling, which we all know doesn't work. We all know we only do it because of the bottlenecks that exist in having human beings look at stuff. AI is a way to get around sampling. And so fundamentally, that seems like what this is. And I'm optimistic that there's going to be more of this. I also think the other thing that's going to happen that's going to tie very neatly into this is we are going to get more standards for how these partnerships need to work. Right.
Oh, yeah. And, CFES just launched their standards.
That's right.
And from what I'm hearing, that's sort of actually being a lot more well received than you'd expect by rank and file agencies, because it's generally considered helpful. And I think there's a lot of financial institutions that will look at something like that and go, well, does joining that put a target on my back? And I think the opposite is actually true. Yeah,
I hope so too, because I think that, there is this recognition, and I've spoken to regulators about this, I've spoken to banks about it, fintech companies. Everyone sort of knows we need to hold ourselves to a higher set of standards. But the thing that's nice about these platforms being built is this is a way to operationalize a lot of that stuff, right? And it's so much easier to have standards that everyone is able to sort of hold themselves to when the operational lift of doing that is somewhat helped by technology and by systems and processes.
Do you know what? When you write down those standards, it's like writing down your policies, procedures, and controls. And the downside of a human is, will they ever understand that 20-page document?
Right.
When what the author meant. Whereas actually for an LLM, that is extremely helpful.
Yeah.
If you want better results out of your AI, give it more context.
Yes.
And constantly tweak that prompt and constantly set up processes around that prompt that make sure it fully understands that context. And that's what a lot of the best AI companies are doing.
Yeah.
Policies, procedures, they are exactly that. They're just a giant bucket of context.
It's a great point, right? Like you take a big policies and procedures document to a human and they're like, oh my God, this is going to be the worst day of my life. You take it to an LLM and it's like, this is the best day of my life. I'm so excited to have all this additional context.
Me to do. I can do that.
This is great. Thanks for giving me more information
I know how
to better predict.
Complete.
Yeah, exactly. No, it's it is a funny way to flip that on its head. So the age of compliance is upon us.
The age of policies, procedures.
That's right. That's exactly right. All right, Simon, give me your second very Simon Taylor-y company.
This is Stablecore.
Okay.
The sidecore for stablecoins. When I say sidecore, I think very Alex Johnson-y. When I say stablecoins, maybe this is like a hybrid.
Yeah, I think it is. And by the way, great marketing, just like on the name and the little like kind of pitch you just did there. That was really good.
Isn't it? So it's one of those things where you hear it and you're like, oh my God.
Yeah.
Somebody's got to buy this.
Yeah.
Financial institutions can offer stablecoins as a payment method to complement ACH, RTP, and cards, and it would also allow them to issue their own stablecoins through this sidecore platform. So it pieces together all of the digital asset custody and blockchain infrastructure and links that back to the bank's existing core system of record, which just looks and feels like a sidecore to me.
Yeah.
It's just the perfect frame for it. So when I saw this, I immediately thought, what has every banker asked me this week? How will I make AI comply? And what should I be doing with stablecoins? A lot of them are thinking about issuing their own stablecoin.
Yeah.
It's like kind of building your own internet. I don't know if that's necessarily the right move.
Yeah.
But having your balance sheet back a stablecoin, offering it as a payments product, custodying those assets.
Yeah.
Like I did a recent episode of the Tokenized podcast, the 8 ways banks can make money from stablecoins.
Oh, right. Yeah, I remember this.
And there are so many ways to make money, most of which are not issuing your own.
Right.
However, it's what everybody's asking. But I really think this offering it as a payment method is going to be a big area, because what we're going to get in the next 6 to 12 months is the Genius Bill.
Yeah.
And the Genius Bill is a fascinating framework for, and as somebody who's looked at global regulations on this, it's probably one of the best frameworks, most robust frameworks in terms of how digital assets need to be custodied, how they need to be risk managed, how they need to be made safe and sound, how audit and traceability and transparency needs, all of the things that you would expect from a good regulatory framework. So that becomes an unlock. Yeah. So a lot of the financial institutions are seeing this coming and going, well, what do I do? Yeah. And I don't know that building a sidecore is the only answer or the right answer, but I can certainly see it being a longer play space. I actually think the better solution for the short to medium term is working with somebody like a BVNK or a Zero Hash or a Mesh or somebody like that does a lot more of the orchestration. Because you need to buy the stable coins, you potentially need to manage FX, you need to manage lots of different blockchains. Like, it's nice to be able to own this as internal infrastructure, but I don't think every bank's ready for that yet. Yeah. But maybe they are in 3 to 4 years' time, and maybe that's where Stablecore kind of gets to. But if I'm FIS or I'm Jack Henry or I'm Fiserv, I'm like, I would want to be paying a lot of attention to this, because there's a non-zero probability that stablecoins become a new way of managing deposits and a new way of making payments under this new bill. Yeah. And if that really did start to take off, then that sort of threatens the existing. I mean, it could displace all of the payments rails. It could displace all of those, because it's just all of that in one place with interoperable technology. It's the internet for money. I would be paying a lot of attention to it. So what say you, Alex Johnson? the most balanced and fair person I think I've seen on the stablecoins to date. That's like, there's something here, but also this is weird.
Yes, well, I try. So stablecoins are a really good test for me on a week-to-week basis that am I being fair constantly? Because there is clearly a there, obviously. But there's also, as always happens with any hot area in fintech, a lot of nonsense that sort of gets tied to them or ideas that are maybe not as fleshed out as they need to be. I generally agree, though, that I think the question that banks need to wrestle with is even if you don't want to make money on stablecoins, even if it's not part of your strategy, which we've already seen, I think it was Bank of America's CEO say that they're looking at stablecoins.
Yeah.
And so I think banks do want to try to make money on stablecoins. But even if you're a little more like, I don't know, the reality is that you are going to encounter deposits that are in some fashion tied to or connected to stablecoins. Yeah. And that's just inevitable, right? And it seems like one of the things I was talking to somebody else about was this idea that from a deposits perspective, obviously if it's a dollar-backed stablecoin, the dollars are still sitting somewhere in a bank account, right? It's just that instead of it being in an end customer's savings account or checking account, the customer might have a stablecoin wallet, and now the custody of the funds, all of that money is stored in one large account stored by some other financial institution. So I think even if you don't want to, as a bank, pursue, stablecoin payments or trying to build applications on stablecoins or trying to pursue cross-border payments use cases with stablecoins, even if you don't want to explore stablecoins from an application customer layer, you have to be prepared for the fact that deposits are going to get taken out of the accounts you have by people who are building at that customer layer.
Yes.
And those deposits are then going to go into custody accounts that you may or may not have, right? And so the challenge, I think, for financial institutions is going to be, we might not have any interest in competing at a customer level in stablecoins, but that doesn't mean our systems don't need to know how to interact with stablecoins.
Completely. If this becomes something as well that the bigger payments companies start to accept, and especially the payments gateways and the acquirer processors, who's going to be the merchant acquiring bank that accepts that? And what does mint and burn look like to that exact point? So when I take my regular dollars to a stablecoin issuer, they mint that a new stablecoin, and they hold on to my regular dollars and might buy some money market fund on the back end. Yeah. And then when I come to redeem that, they burn that stablecoin and then give me my dollars back. Yep. And so what does that look like? Is the bank going to be doing that? Is the bank going to be working with somebody else to do that? Yep. There are some meaningful questions to answer if this thing continues to scale.
Well, and whose responsibility is each thing, right? And so, I think going back to the Genius Act and some of the regulatory frameworks that are going to come around, a lot of this so far has been very much state by state. New York has a different approach to regulating stablecoins than Wyoming does. But once we get sort of a federal regulatory framework for this, it should really clarify the responsibilities of each party. And I would not at all be surprised even if the bank is not actually issuing the stablecoin themselves. So let's say they're not issuing a stablecoin, because I agree with you, it's probably unlikely that a lot of banks get into stablecoin issuance. I still think there is going to be a role for the bank to essentially be able to be a second layer of verification and reconciliation and supervision.
They're the telco.
Exactly. And so they're still going to have to follow a set of rules. They're going to have to sort of treat stablecoin issuance and custody accounts for stablecoins with very specific treatments and accounting principles. So there's going to be a set of very specific requirements for banks, even if they're not issuing the stablecoin, but they're just custodying the account. And going back to the core point of what these guys seem to be building, does your core system account for that? Is it flexible enough to do that? And as we know, and banking as a service is a good sort of analog example of this, cores couldn't handle banking as a service, which is actually in a lot of ways much more simple and straightforward than stablecoins. So if you're arguing that you need a side core for banking as a service, you absolutely need a side core for stablecoins, because they're way more unique, different, challenging to deal with than banking as a service. That's easy by comparison.
Absolutely. So it's worth going down and breaking through what the Genius Act says, because
Yeah.
I think what that will do is just bring a lot of clarity to what I, as a financial institution, need to do if some deposits show up that might be linked to a stable coin.
Yeah.
So they define stable coins as a digital asset used for payments and settlement.
Okay.
It must be issued by a licensed entity and cannot be algorithmic.
Yep.
So
Love
no
that.
Terra Luna.
Yep.
It has dual regulation by federal and state regulators, with bank supervisors also having a role. And then anybody who issues a stable coin becomes a new type of entity called a payment stablecoin issuer, or a PSI. And the licensing follows the Durbin 10 billion asset cap for federal state oversight. Issuers must back their stablecoin one-to-one with high-quality liquid assets, so that can be cash, U.S. Treasuries, custodied at FDIC-insured institutions.
Yep.
And reporting and transparency is required. Large issues can be systemically important. Stablecoins can be used across borders, but must be registered in the U.S. if they intend to operate in the U.S., and they mandate KYC, PSA, so on.
Yep.
So buried in that is something really fascinating, which is it opens the door for this model of U.S. Treasuries being the standard backing, as well as central bank reserves and sovereign debt.
Yeah.
So essentially, Fed master account sort of happening, reserve account access is sort of happening for a stablecoin issuer. A lot of bankers I've been speaking to are quite interested in the idea of taking a few basis points out of the money market funds.
Sure.
We're sort of leaning into narrow banking a little bit here, aren't we? It's sort of walking that tightrope.
We absolutely are. And I can tell you that folks who work at the Federal Reserve are thinking deeply about what the adoption of stablecoins and a new regulatory framework to encourage stablecoin innovation in the U.S., which I think we all agree is needed, what that means for the fractional reserve banking system versus more of a narrow banking system, because you're right. It does really start to change the dynamics around a lot of this stuff, because a stablecoin, and Simon, I won't make you on this podcast get into a whole discussion about stablecoin yields, which is its own whole sort of ball of wax. But just in general, the idea of an application built on stablecoins providing a narrow payments or fund storage use case, by definition, it really isn't, and it's dollar backed. You can only hold it in certain reserves. It's narrow banking, right? It's not fractional reserve banking. And the impact of that in terms of the liquidity on banks for lending, their access to cheap deposits, like the impact of that on credit, I think is a really interesting sort of thread to pull on with this. And so the stablecoin conversation gets us into all kinds of interesting, like, how is this going to restructure the way that the banking system works? Because it doesn't take that much volume to start to notice an effect here.
Are they turkeys voting for Thanksgiving by adopting this thing? You kind of got to wonder. And so then the other side of it is, does it accelerate private credit? Because some of the biggest adopters to this is BlackRock, KKR, Franklin Templeton. They all have tokenized treasury money market funds. They're all in DeFi trying to do the lending. So your competition for lending. Or is the answer the other way around, which is, I need to be compatible with this space.
Sure.
I need to be offering deposits as an alternative to money market funds so that I can lend, and I need to be compatible with this future. There's still like a lot of folks trying to figure out what to do with it, but I would say that you should be paying attention because it's a non-zero probability at this stage that stablecoins, I think we can say confidently, will continue to exist.
For sure.
B, the Genius Bill will be an unlock. And C, when that Genius Bill happens, domestic use cases will start to happen. We don't know which. The question is, how do you position yourself to potentially take advantage of those?
I completely agree. I will tease one small thing, Simon, which is I've recorded a podcast that I haven't told you about that's going to be coming out the week after this one, that we have a very interesting conversation about a domestic payments use case for stablecoins. So again, trying to be as open-minded as I can. We had a very good nuanced conversation about that. And I agree with you. Like, I think that once those first two things happen, then we'll really see what we can actually build with these things. And it won't just be cross-border, put it that way.
I agree.
Okay. Awesome. Let's wrap up with one last company, which I will go quickly through. It is Astrada. Have you heard of these guys?
Yes, I have.
Okay. They just came out of stealth. That's right. Bring your own cards. So just came out of stealth, and it's essentially bring your own card as a service would be
Yeah.
the way I would describe it. And so folks who've read my newsletter at least probably are familiar with Navan and the sort of bring your own card philosophy that they've adopted, where briefly they were issuing their own corporate card that was compatible with their Navan travel system. What they decided to do instead was to apply what they learned in creating a corporate card to essentially build the infrastructure so that any card from Visa or MasterCard, any commercial card, could be plugged into Navan. And that was very appealing because, especially for larger kind of commercial corporate enterprise customers, they don't really want to be held hostage to that, right? Like they want to be able to bring their Citi card, or they want to be able to bring their JP Morgan Chase card or whatever.
Because there's a whole bunch of other benefits that they get from that bank as their broader organization.
That's right. They get treasury management and corporate banking and commercial lending and all of these other things from those banks. And they need to be able to bring the card with it, but they don't want shitty travel management software. They want something good.
Yeah.
So Navan built that for themselves proprietarily, and it's worked really well. Astrada is essentially trying to make that a service. And so now if you are a vertical SaaS company that is building in spend management capabilities, or you're just sort of a horizontal spend management platform, or you're even like a large ERP system that has corporate spend management as a part of a larger suite of offerings, you can leverage this service to essentially allow end customers to bring whatever cards they want and enroll those cards in that software. And the unlock is you can have your software get access to all the data necessary to drive your workflows, right? And so the reason, if you go back to like the early days of a Ramp or a Brex, is
that's what works.
That's right.
I've got the data and I can drive my workflow and expenses feel like magic.
That's exactly right.
Imagine having expenses that feel like magic for everything else.
Yes, exactly. Because like the only reason really that you had to issue your own card back in the day was because there was no way to get the data without issuing your own card.
Yeah.
Now, you don't have to issue your own card to get access to the data to drive your workflows. And so the benefit that you can go out to the market and talk about is, look, you already have a larger relationship with this bank that you get a lot of value from. You don't necessarily have a problem with the corporate card. You have a problem with the lack of integration of that corporate card into our software and the cool things we can do with that. If you're a small business owner and you have, say, 15 employees, I've heard this over and over again, you actually want all your employees using your card because you want all the miles and the benefits from it, right? And so you don't want to adopt some other card to use better sort of vertical SaaS platforms. You don't want that SaaS platform to try to force you to use their card. You want to use your own card, but have all the magic of the software work. And so it's this really interesting trend, Simon, that I've noticed around the sort of unbundling and rebundling in a B2B software context, right? And we saw this with Stripe actually a while ago when they decoupled their payment processing from the rest of their software. It's the same idea, which is, you know, for certain sort of wedge products, it works really good to bundle everything together and create this closed ecosystem, this walled garden. Apple, Simon, which you love. There is a benefit to doing that, but I think particularly in B2B, once you start to try to go outside of that ideal buyer type with that closed ecosystem, you start to run into problems, right? Like
really quickly.
They want the thing, they want the magic of what you're trying to pitch, but they don't want to be locked into one thing. They are more like Android, Microsoft type buyers. And that's where you need to start unbundling or creating a modular approach to what you're doing. So Astrada's approach is essentially to provide the service that allows for corporate cards to work with various different spend management software platforms.
Well, and it's not just spend management. It could work with other workflows. Think about accounting workflows. Think about all of that sort of stuff. Bring your own card also could work for consumer.
Yes.
So what if I want to bring my own card to a different kind of wallet? What if I want to bundle it inside of a platform? Like, what if I want to do things with it inside of a marketplace that just works? What could you build? I think making that data available has always been extremely difficult inside of the cards world. I think the framing of bring your own cards is one thing. The framing of bring your own data is another. Like I think about what Rory's doing over at Not API, and once you unlock that data, you start doing really interesting things. And that's been what's holding us back. And you think about the amount of corporate card programs that are out there that could now potentially get away from Amex.
Yes.
Because Amex was always the place that had that all-in-one.
Yep.
They did the travel and they did that, and then
They just bought Center.
Yep.
Which is a spend management platform that's roughly comparable to a Ramp or a Brex, but not nearly as good as a product. And so, like Amex is a good counterexample to a lot of this, which is like, I think Amex in a lot of ways is stuck in the past, going like, we have to provide the all-in-one platform for this. And what they're not realizing is, look, there are so many cool experiences being built, products, and it's not just like general products. It's like vertically specific. Like someone is out there building the absolute best accounting platform for law firms, or they're building the best spend management platform for construction companies, right? And each of those has these little tailored workflows and these little things that they're doing. And the thing just needs to work. And they don't want to choose between that and working with American Express and getting all of the stuff bundled together. And so I think, Visa and MasterCard have done a really good job of opening up their APIs and opening up access and realizing that the value of their cards is the data, not the actual card.
Yes.
And facilitating that. American Express, because they're both an issuer and a network, they fall into this trap of like, oh no, we have to protect our issuing business. We have to protect all these sort of legacy things that are bundled together. And I worry for them that they are falling behind where Visa and MasterCard are allowing the rest of the market to go. And Astrada is sort of an enablement layer that sits within that new world.
There's always something to be said for Amex is Amex, and their rewards program is what brings them to the dance. And God, Americans love a rewards program. And so there's always going to be that element of what they do, and they can.
Well, and you remember when they broke up with Costco, and they were like, "We're not just any vendor; we're American Express," and they like walked away from the table. They have this attitude.
Yeah, they do, and there's something premium about being a bit aloof and a bit of a douche.
For sure. Yeah,
it kind of works for some.
It does work for them. Yeah,
and so. Maybe they're not wrong to do that, but they're also missing the growth opportunity.
Yeah,
and the growth opportunity here is. Fintech has been unbundled quite successfully and continues to be so. And the rebundling of that is where the opportunity starts to live. I mean, even Brex is doing it. They're embedding Navan inside of Brex.
That's right.
And this was a competitor. So
they had their own travel solution before, and they realized best of breed is what our customers want.
And so being able to go to what customers want is enabling these companies to come up into the type of enterprise buyer that Amex typically had a better place with, or the financial institutions typically had a better place with.
Yeah.
And I do think what's fascinating is even some of the largest commercial card programs, some of the largest banks are showing a willingness to partner with fintech companies and to use new technology that I don't think was true 3 or 4 years ago. And that's a great place to be.
No, I totally agree with that. And I think that, we are going to see more of this type of modularized infrastructure sort of take over, particularly in B2B, because these buyers are just very different, and that is what they want and kind of where they want to go. So very intrigued by this one. Simon, we're almost out of time, but before I let you go, can we manifest something quickly? I can go first.
Yeah, please do.
Okay. All right. So a theme, and something I'm going to write about in my newsletter too, but a theme that I've picked up on at Fintech Meetup is this idea that there are a surplus of great fintech products out there, and there is a deficit of good distribution channels for those products.
Ooh.
And so if you think about like B2C fintech, everyone I think still realizes we're only like 1% done, to use sort of a Simon Taylor aphorism. We are only 1% done building better products for consumers in financial services.
Yeah.
So like it's absurd to say,
but sure.
No, 3%. Maybe we're only 3% done with building better fintech products for consumers, right? Like clearly it's absurd to say, oh, B2C fintech is dead from a product perspective. But I think sometimes when people say B2C fintech is dead, what they actually mean is you can't ask me to sign up for trying to acquire customers directly anymore. I won't do it, right? Like there is no more sort of like battle-scarred fintech founder than someone who's fought the B2C acquisition wars for years, right? They're just like, they're tired.
The traditional distribution of SEO and ads and all of that.
I mean, it's expensive. And this is the old, I think it was someone at Andreessen who made this joke a long time ago that most of the VC money ends up going back into Google and Meta's pockets because it's just B2C advertising, right? Fintech companies and their investors don't want to do that. So the thing I've been thinking about, Simon, is how do we build the infrastructure to funnel B2C fintech products into banks and credit unions distribution channels. And the sort of catchphrase that I've used to sort of talk about this idea in the past is fintech franchising, right? So I built the thing and it makes sense. It's very useful to the market. And in a perfect world, every community bank and credit union would offer this product to the segment of their customers that it's good for, right? It could be digital banking for doctors. It could be better lending product for teachers. It could be any number of different things, right? But I built a better widget. The problem I notice is banks and credit unions, even though they've woken up to fintech, they don't really have the infrastructure to like white label and easily resell great fintech products.
Yeah.
And so there is this sort of challenge about how we get these fintech products out there. And so I don't have a good idea, honestly, about how to do this yet. But I think if I'm manifesting something, I would like to see more infrastructure get built to funnel fintech product innovation into bank and credit union distribution channels.
I think to build on that idea, we need to flip the idea that the only ultimate responsible entity is the financial institution themselves.
Yeah.
Because if they're franchising something, they are not the franchisee, they are the franchisor.
Yeah.
And so no matter what they're buying and selling through, it's like McDonald's buying burgers.
Yeah.
Like you're still McDonald's.
Yeah.
Your franchisee is something different.
Yeah.
And so the dynamic is upside down from a regulatory standpoint.
Correct.
We need a different regulatory dynamic, and maybe we have a window to try and achieve something that would be broadly more helpful.
Yes.
And again, I'm not going to try and prejudice what that is. People have proposed various things. The US is a zoo when it comes to these things. But we definitely, if I was going to manifest anything, it was something like the Genius Act for everybody else. Like, can I have a Genius Act that's not just for stable coins? Can I have it for embedded everything?
Sure.
Because we need a category that isn't, sort of a payment stablecoin issuer. We need a category that is like MTL but embedded. That it actually takes the idea of you don't just move money, you do other things.
Yeah.
And that is just such the hack at the moment is to say, you know what? The bank, you're in charge.
Right.
And the bank has a different risk appetite, and it has a small team, and it has a worry, so it won't reuse its distribution. Yeah. Is what it is.
No, I think you're right to wish for it. And, we've been begging for modernized regulatory frameworks for a long time, but it does seem stablecoins will be first, but it does seem like we have the chance to get them over the next 4 years. And so I am excited about that possibility, even if at the moment it feels a little chaotic. Simon, it was so fun to do this in person. We should do this every time. Why don't you just fly to Montana every month and just, we can record in person?
Yeah, sure. Why not? I like being cold. I like being far away from my family.
Sure.
These are all wonderful things.
We can sell this.
What you need to do is franchise a Marks and Spencer's, maybe a Waitrose. And if listeners don't know what those are, you're missing out.
Okay.
And then I'll come hang out.
All right, fair enough. We will work on it. Simon, thank you so much. This was awesome.
Thanks, sir.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.